Hello everybody and welcome to Green Star Trading with me, Tom. All views, opinions, ideas expressed in this video are my own and do not constitute financial or trading advice in any way. Right, welcome back to YouTube and it's time for a Bitcoin update. There's several things I want to discuss today. So, before we come into the Elliott Wave count and all this stuff, we're going to talk about the macro, a little touch on it, I don't want to get carried away, sentiment, classical analysis, cycle analysis, Elliott Wave analysis, and we're going to try and be as brief but as detailed as we can be at the same time. So first things first, discussing the macro. This is a subject which we could talk about forever, and we could spin around each other in ever decreasing circles until we disappear off our own backside, and therefore we have to be careful based on making assumptions on things that we do not know. So what do we know regarding the macro? Well, we know this cycle's been very different. We've come out of a post-high inflation environment, right? Or we've come out of a high inflation environment since the last cycle, the likes of which we haven't seen in decades. We've gone through a subsequent rate hiking cycle, the likes of which we haven't seen in decades. We have had sustained higher rates and QT, quantitative tightening, meaning that the Fed has been running off its balance sheet rather than expanding it. And this QT environment, this high rate environment, and the suppressed business cycle, the ISM report on business for manufacturing has sustained below the 50 bound month after month, year after year now, with no clear business cycle in sight. We've had building permits collapsing month after month after month. We've had rising unemployment. Okay. And yet we've had a bull market. So that's number one. Okay. The traditional drivers and environment that a lot of your macro experts would say this should be greater market returns or reduced market returns, bear market, bull market, secularly, not cyclically, right? Would be wrong under those assumptions, because the crypto market, Bitcoin we're talking here, has gone to another new all-time high. Stock market's gone to the moon, driven by the AI companies and the big techs, right? Gold's gone to the moon, right? So markets have elevated, but even broader indices whose economies are dog shit have gone higher under this circumstance where they shouldn't. Right, so we've got to be careful not to take too big a chunk out of a macro sandwich and make assumptions, because it can prove us all wrong. All right, what's changing in that macro environment then? Well, continuing with what we know is happening, for the meantime, rates are coming down. The bond market's being incredibly stubborn, even though the central bank is cutting rates and continuing to make rate cuts. The bond market isn't particularly interested and has gone sideways for 3 years. In terms of bond prices, in the 10 to 20 year relationship, prices for inverse to yields, but we've basically gone nowhere. QT is ending in terms of the bank balance sheet. Fed's bank balance sheet runoff is coming to an end. This does not mean that expansion of the balance sheet is going to start, but we know that the QT is ending and rates are coming down. These traditionally are going to be viewed by the market as tailwinds. Right, things are going to improve, things are going to get better. The lower rates, right, should feed in to an expanding business cycle and more favourable business conditions for an expansion in the business cycle above the 50 on the ISM. This should relax credit, and this should affect mortgage rates, of course, as well, and the housing market, and everything under this environment should improve. Okay. And yet, we're talking about the worst sentiment I have seen at the high of the market, in the crypto market at least, I've ever witnessed. Okay? So, what does that mean and why is that there? So, my personal opinion about why sentiment is so bad. So, in the previous bear markets, if we just bring up the bulls and the bears for the moment, right? In the previous bull markets, everybody made money. It's pretty easy going. And during the bear markets, those who were not leveraged, long-term holders, saw an opportunity to reaccumulate, sit it out. Those who were leveraged got wrecked. Then during the bull market, people made money easily again. Bear market, they didn't. One of the reasons this cycle has been so different is all your altcoin holders in these previous bear markets are underwater. Some become bag holders for life and the market never recovers, right? But they always made money during the bull market. The underperformance of altcoins in this bull market has made this bull market very different. Bitcoin holders are up, right? But a lot of the altcoin space have become bag holders during a bull market. Not a bear market, a bull market. This sucks internal liquidity out of the market space. In other words, the moving from profitable trades in the altcoin sector into Bitcoin back and forth simply hasn't been there, because so many people have become bag holders, have gotten themselves underwater and stayed underwater the whole time. Now, you could figure out multiple reasons for this. Maybe it's just a lack of overall liquidity, rates being high, so on and so forth. But I think one of the biggest factors, without a doubt, is just a massive dilution of the space. You know, 1 million projects plus, or whatever it is now. I don't know. Nobody cares, really. I couldn't give a shit. At the end of the day, it's one of those ones where if you'd all taken your money and put it into Bitcoin, we'd all be at $1 million Bitcoin by now and laughing our asses off, right? But that's not what we did. And it's not collectively mine or yours or anybody else's responsibility to tell people what to do with their own money. This is the market, made of free actors who can go and buy Trump coin or whatever the fuck they want to do. That's up to them. But I would argue that the dilution has been a significant factor. Okay. So we've come into an all-time high in Bitcoin with extremely bearish sentiment, which is extremely odd. Bull markets finish in euphoria. Everyone's right. We're going up forever. The next target is such and such. We're going on the moon. Right? That's how bull markets tend to die. Because that's how we offload our crypto onto people. They get super, super bullish and we sell it to them. Right? Now, this hasn't happened. We're here, and everyone and their mate on the internet is talking about how we're in an AI bubble in the stock market. Well, if everyone's talking about it, it can't be true, because there's no way Joe Public knows it. If he's figured it out, right, or as Old Man Kennedy put it, when a shoe shine boy telling you what stock market's going to do, it's time to get out, right? We're at that point now where everyone and their mate is not being super bullish. They're being bearish. That's a conflicting message, is it not? That retail and the general public are bearish about the stock market. Surely we as traders should be bullish then, right? Because we don't want to be doing what Joe Public's doing. And yet we can't argue with the extreme valuations. We can't argue with the massive forward PE ratios. We can't argue with some of the circle jerk funding that's going on. Right? This cycle is very different. I've had the luxury of trading in a post-GFC world, a post-global financial crisis world, where rates were low for 14 years, basically at zero. QE was never ending and the market only went up. Since COVID, macro situations have changed. Right? And I think this cycle throughout equities, the K-shape between the real economy and equities, right? Between look at gold, for example, going to crazy new highs. I've been a long-term gold investor for a long time. It's been very beneficial to me, but in the gold market, the sentiment was correct. Even more so, much more so, in fact, actually, than even the stock market, where people were queuing around the block to buy gold, right? Because of a debasement trade, dollar's going to zero, and every fucking expert who thinks they understand that and is completely wrong about it, but besides the point. The sentiment for the market to top here is not correct. So we've spoken about macro, what we know, what we don't know, and why it's a foolish errand to run around saying, well, because of this is going to happen. Nobody fucking knows. Okay? Nobody knows. And then to turn around and say, well, sentiment isn't right. I'd argue it isn't, right? But maybe this time is so different that we don't have a euphoric blow off top. So that's a lot of rambling to start the video with, and I apologise for it, but I just wanted to clarify that there's a lot of headwinds out there from a macro point of view that look really bad, and everyone's really bearish and is calling for a recession and a peak. And there's a lot of tailwinds on the horizon just around the corner which suggest everything's going to be rosy. We're in that inflection point where nobody has a clue how it's going to work out. Okay? Sentiment has been destroyed by the dilution of the market. people being underwater during a bull market rather than during a bear market, which I think has stifled internal liquidity for the marketplace. Yeah, and that's my view on the sentiment and the macro. So now let's talk about the classical analysis, and then we'll talk about the Elliott wave cycle. Sorry, and then we'll talk about cycle, classical, then Elliott wave. So market cycle, 4-year cycle. We've been talking about this on the channel for years, and I mean years now. If you don't believe me, go back and watch some prior videos. We had this previous finish line in place ever since we had the lows of 2022. We've been anticipating that if the bull market was the same length as prior bull markets, then we would finish any time from October this year through to December. Maybe into January at a push. Right, so we crossed that line. This does not mean, right, that we have to bottom when the anticipated bottom is at November 2026. But if things play out as they have before, we can assume we're in a bear market. Now, I'm not going to say we are, because I don't know. The point of this video is to not jump onto the ideas that we don't know, but to try and jump on the things that we have witnessed and seen before. Okay, so you could turn around and say, oh yeah, Tom, but it's going to be a 5-year cycle instead of a 4-year cycle because so-and-so says that we're refinancing the debt a year later. And it's like, yeah, that could be true, but we don't know. Okay, what we do know is that prior bull markets have lasted 3 years and the bear markets have lasted 1 year, creating a 4-year cycle. That's what we know. Okay, doesn't mean it's going to happen again, but that's what we know. Right, so if we know that, we could be in a bear market. We could be in winter. Spring, summer, autumn and winter. We've rolled over into winter, and now we're going to have a bear market. It's going to last roughly a year. Okay? Now, if that's the case, let's just entertain it for a moment. If that's the case, so fucking what? Are you going to cry about it? That you get to buy Bitcoin at a 30, 40, 50, 60, 70% discount in the next 12 months and you've got time to save money for it? You haven't got much time. A year is that to me nowadays. It goes by in a blink of an eye. Right? So you're going to bitch and moan about it, or you're going to welcome it? I say we should fucking welcome it. Bring it on. If this is it, bring it on. Okay? And I say if, because I don't know. But if things play out as they do before, this could be it. So bring it on. Right, so if it is going to be it, what can we expect? Well, correction-wise, we've seen some pretty big ones. Right? We've seen a 93% correction back here in 2011, 86% correction back here in 2014, 84% correction back here in 2018, 77% correction back here in 2021. So maybe we get another sharp, which is a corrective zigzag structure with no new price extreme above the prior high. So it's just straight down, effectively, and it's a series of waves. And maybe we get roughly the same again. So we could say, right, well, this area here is going to be filled with a sharp structure. We don't know how deep it's going to be. Right, we're going to get a zigzag of sorts. Right, and we're going to get, this has been 77% decline, this was 84, 7% or so less, so maybe a 70%, maybe a 50%, maybe a 40%. There's no way of knowing how much deeper this one's going to be or less deep, right? We've gone from the mid-90s down to roughly the mid-70s over each of the cycles. But let's just say a 50% decline, right? Let's just say we cut the price of Bitcoin in half. I don't know if it's going to be more, I don't know if it's going to be less. Okay, and maybe we can expect something like that. That would be a little excessive, I say, but let's just say, right, 70% again. Comes down to here, and from a time frame point of view, seasons, the long-term secular bull market, and by that I mean since its inception with higher highs and higher lows. This cyclical part of it is now about to change from bull phase into bear phase, and we're about to get this winter, this sell-off. But it's part of a long-term secular bull market, which wouldn't be invalidated unless price came back below 15 grand. Right, long way away, yeah? So let's take the price range, put that into price corrections. This is just a projection. We'll leave the polyline there. We'll put the rectangle into corrective forms. Like so, we'll save the chart. Right, Another thing we'll talk about is the underperformance of the post-halving cycle. Right. So we're building up evidence here. So the post-halving cycle, halving data. Prior post-halving cycles made up the vast majority of all the gains within that cycle. So in the previous bull market it was 91.6%. In the one before that it was 97.4%, and the one before that was 98.96%. This one it was 59%. Which is shit by comparison, isn't it? Right. Sentiment's poor, returns have been poor. Hence why it doesn't feel like the top. Putting it simply, it doesn't feel like the top for me. So from a sentiment point of view, I'm very much conflicted over it. It doesn't feel right. But maybe this is broken. The halving returns are broken, but the 4-year cycle is correct. Why could that be the case? Well, if people have gotten trapped underwater, there's been the restricted liquidity, we've been in a higher rate cycle environment, no business cycle, GDP's been basically only growing by the amount that the AI companies have been growing by, and the rest has been flat. We've got big money in here for the first time, with big management. There's a whole bunch of reasons as to why you could argue that the returns have been poor. But why would we be now be in a bear market? Well, for the same reason that this cycle has been continuing 4 years after 4 years after 4 years. There might just be long-term Bitcoin holders who are just selling. Because from a seasonality point of view, from a cyclicality point of view, over the long term, this is when you sell Bitcoin. And that's probably enough with some of the whales out there to start driving the price down. So, anyway, we're going back in circles now, so we've got to be careful. But either way, that's the market cycle stuff covered that I wanted to go over. We could be in a bear market. If we are, we can expect the usual behaviour. It will maintain the higher highs and high lows of the secular bull market, which has begun since 2009, but this is the bearish phase of it, and it should be welcomed, right? Because we're going to make a lot more money coming out of this when it's over. Okay. Does it fit with everything else at the moment across the stock markets, the way it's behaving, the future potential tailwinds we should be gaining from a macro point of view, behaviour in other spaces, continuing expansion of the money supply? It doesn't really fit with any of that, and it doesn't fit with sentiment either. So it's a very unconvincing top in those regards. But from a time frame point of view, we're selling because the 4-year cycle says we should. Maybe that's what it is. I say maybe because I don't know. Right, so let's now move on and let's look at some classical analysis for a moment before we come into the Elliott wave stuff. So, we're back at the 60 weekly exponential moving average, or just above it. We have the 10 and the 20 weekly averages lines starting to cross over. They've done this during prior corrections, like we did here when we came back to the 60, like we did here when we came back to the 60, like we did here when we came through it. Now, on the daily time frame, if we come in, we can see that the 60, of course, because there's 60 trading weeks, 60 trading days, sorry, in a quarter, and there are 250 trading days in a year. Now, you might say, yeah, but Bitcoin trades 7 days a week, and yet, strangely enough, these exponential moving averages line up very nicely, and I think with the institutional exposure from the ETFs and the big brokers coming on board, the big banks coming on board, we might get a much more weekly based behaviour. We'll I don't know, that's just conjecture, we'll see. But we've come through a 250 daily exponential moving average, like we did here, like we did here, like we did here. So I don't know if you can remember, it seems like people forget every 5 minutes. Sentiment here was on the floor, everyone was crying, we went higher. Sentiment was on the floor here, everyone was crying, we went higher. Sentiment was on the floor here, everyone was crying, end of the market, we went higher. So, same shit, different day, right? Same shit, different day. Same idiots which continue to miss opportunities will always miss opportunities because they're idiots. They just can't help themselves, and they won't learn from any prior experience. And the reason is because they're probably levered up to the fucking eyeballs, and they get wrecked every time it sells off. But I don't give a fuck if you're offended or not. It's really at the point now, I just don't care anymore. Do it right or don't do it at all. And so, sentiment gets pretty shitty down here, and this could just be another low. So we could be in a bear market, we've spoken about that, but we're also in an upward trend of higher highs and higher lows. Okay, now if we look at the indicators for a moment, we're oversold conditions on the daily time frame, negative momentum on the MACD, no clear divergence bullish on the daily time frame, and we're extreme fear conditions on the crypto fear and greed index. We've come back through the 250-day exponential moving average. We've come back into support. All right, prior lows, prior highs. We are in roughly the right area to be bullish. It doesn't mean it's going to work, and it doesn't mean that we're not going to come crashing down, but what it does mean is you can trade it and you can manage risk, and if you manage risk well, right, you won't take any significant losses, and you won't be a bag holder, and you may have found a nice entry point. Okay, all of those things are possible. Right, so it's when we get very bearish like this that we have to start pricking up our ears and paying attention to the possibility of it still being bullish, even everything else we've already spoken about. Being a trader is often living in a state of contradiction between short-term opportunities and longer-term cycles. Okay, so on that note, let's look at the longer-term cycle and some of the evidence to suggest that things may well have turned negative. We're continuing our classical analysis here, and we're trying to be open-minded. So this is the monthly time frame. Right, the 60-month average tends to be the lows or below it on this time frame. We've come back to the 10 monthly average. We haven't forked through it to the 20. We've got long-term bearish divergence on the monthly time frame across prior highs from March 24 through to January 25 through to the highs of July 25. These three descending highs in the RSI are diverging from the three higher highs in price. This is what we call bearish divergence. The longer term resistance and support suggested that we were going to come back up to these extreme conditions on this trend line and back down to this, right? This would be the final move back up. We may have changed. Like I said, this cycle has been very different. It's felt very different. But maybe we still do it. Maybe we still do it, right? But it's not a good look. Let's just be honest, it's not a good look. MACD. Average is crossed through the signal line, okay? Here's the big bullish phase, bullish momentum, slowly dying off. Here's the first red monthly candle, a red monthly bar on the histogram. Average crosses through the signal line on the monthly time frame tends to be synonymous with the market top. So let's have a look what's different this time. So bearish divergence here last time. This is a higher high, right? Whereas in the MACD it's a lower high. So price diverged from the MACD. Not the case here. So this bit of a trickster's high. No obvious slowdown in momentum, but we did see a slowdown in the RSI. When the average crosses through the signal line on this time frame, this is a bear market. When the average crossed through the signal line on this time, that was a bear market. Alright, and if we expand it to all the way back to the 2011 bear market, when the average crossed through the signal line on this back here, that was a bear market. If that signal is the same again, we're in a bear market. If it's the same again. Now, can that line cross and recover inside of a bull market? Yes, it can. It's done it once before. And this was during COVID. Here's the 2018 bear market, MACD signal crossover. Here's the recovery, positive, and then negative again. No new bear market, no new lower low. Price sustained at a higher low. Then we had the big COVID melt up, post-COVID melt up, right? So it can happen. So not every cycle is the same, and not every section of every cycle is the same. We don't know what's going on, but if this topping structure plays out as it has in the prior bull market in 21, as it did in 2018, as it did in 2011, then the top's in. Okay? So you're going to probably head spinning now saying, Tom, there's so many contradictions. Yeah, this is why we trade differently from how we invest. And we manage risk over different time frames, because the markets do not give us a blueprint and a perfect map of what they're going to do in the next hour, the next day, the next week, the next year. Right. Therefore, we have to account for that. So let's come back to the daily time frame and bring up our M2 money supply. We haven't looked at that. Right. So here's the M2. Here's Bitcoin. Right, as you can see from the recent highs where they've been tracking each other, right, M2 has continued higher and higher and higher and higher and higher. Bitcoin has lagged and lagged and lagged and lagged. Okay, if we look at gold, for example, since the last consolidation period for gold, which has basically been tracking with Bitcoin, gold ripped higher, Bitcoin went lower and sideways. It's just underperformed. And that's part of the sentiment, I reckon. It's contributed towards sentiment. Prior cycles, we can see that there has been a period where M2 has detached from Bitcoin. So here's Bitcoin and M2 coming up during the 2020 cycle. We get one more high out of Bitcoin. Bitcoin starts coming lower. M2 continued higher until they synced up again. We could be in the same circumstance this time. Right. Or we could race to catch it up. Okay? We won't know for certain until we get through certain levels. So now that we've covered the classical analysis, let's talk about the Elliott wave analysis on the larger time frame. Okay, so I had a comment on one of my previous videos which shows the depth of misunderstanding or lack of understanding, I think, that some people suffer from when they're trying to navigate these assets or these markets. So I said in the previous video, bull market dead under 74458 spot 42, and somebody was like, that's so stupid, what's the point? Right, what's the point? A system must be rubbish if it can't confirm that the bull market is dead before this point. Well, unfortunately, the system isn't stupid, you're just stupid because you don't know how to take advantage of it. Okay, no one's telling you to use Elliott wave to make trading decisions. We can incorporate it into our trading decisions and our risk management and how we do the two together, but we don't make decisions because some macro expert told us that we have tailwinds behind us and we should buy. We don't make decisions because some moving average crossed. We don't make decisions because the Elliott wave count says we have to do this now. We put the whole thing together holistically, and then we manage risk and manage our entries. Okay, and we take a holistic view of all these things together. When I say that the bull market is dead beyond this point, what I mean very clearly is that all of the bullish counts that we have, and there's only 2 of them, which allow the market to go higher, are invalid at this point, and the only one which still works is the bearish count that the major top was in. We can prepare and trade from that bearish top if you wanted to. Time has already come and gone for you to get the best entry, but you could have taken it. I've spoken about it to my patrons. I do weekly updates on Bitcoin, gold, and the SPY, and sometimes a couple of other assets every week. Right, so these questions come up. The same could be said for being bullish within the upward trend now, and at any time until this is invalidated. What do I mean by that? Well, let's just say that the upward trend of higher highs and higher lows continues. Right? The trend is your friend. So let's say it continues. Right? We're in the 50 to 61.8% golden ratio buy zone, or I wouldn't say buy zone, target zone. We could come deeper, right? We could come to the 78,689. We could come all the way down to here and not invalidate this count and then move to another high. Imagine the psychology and the sentiment at this low. Be honest with yourself. It's going to be absolute shit. Everyone's going to be panicking. It's the end of the world, right? So if you were to get 5 up and 3 back to a higher low, and you can manage risk between these 2 levels above this level, right? So that you would not be stuck in here bag holding, but potentially have captured all of this value and all of this value, right? Would that not be a good trade? I think that would be a good trade, right? It's not going to be easy to pull the trigger though, is it? Because everyone's going to be crying and whining and bitching and moaning and talking about how it's the end of the world. Alright? That's what I mean. Everything's open until that level. You get through that level and fair enough. You have to abandon the idea of trying to find a bullish setup in the shorter term. But you've got to be careful. Why am I laughing? You've got to be careful because that's a liquidity grab into support. Right, that's why trends come back to support, prior resistance support. Why? Because the only thing stupider, right, than bitching about invalidating at this level would be selling here. What do I mean by that? Market might well do this in the longer term, right? But when we come through here and run all the stops based off of this resistance back tested support from this trade into this high, the second we come through here there's going to be a massive liquidity grab. All the stops get run, and then some moron or many morons come in and see this sell level, this level, this invalidation level, and they sell it. right? They take the money and they hand it straight to the buyers here who are like, well, I don't care if this runs 10, 20, 30%, I'm going to absolutely fucking rape you. Right? Market rallies, then comes lower, and the people who then buy the top, because they're equally stupid as the people who sold the low, they get fucked. And we swing to another low. There's a lot more than just pricing validates here, that's a stupid system. It's a bit more nuanced. Okay? But either way, I digress. Let's look at the longer term Elliott wave counts now, shall we? Primary count, and then we'll come into the smaller time detail in a little while. So what if the market's ended? What if it's over? What if it's done? Right? What if we're into the next bear market, we're into winter? Okay? Well, here's the obvious support. Right? This is between 70,000 at the 50% retracement down to the 65 run over and the 61.8% golden ratio, Fibonacci ratio here of 57,000, but we could come deeper. 27,000, 39,000, these are your major FID levels. This is the main area of support I'm interested in. Prior highs 74,373 all the way through to the 61.8. Prior highs, loads of volume in here, loads of volume in here, obvious demand zone, right? Zigzag down into this over a year, and there's your bear market, there's your next bear market. Right, could come deeper, but there's your next bear market, where the first place I'd be genuinely interested in. And what a surprise. It happens to become interesting the moment we invalidate the bullish counts. Can you imagine the psychology of coming down this low, getting stopped out, getting wrecked, right? And then the market goes to an all-time high. That's perfect for how markets should operate in terms of efficient allocation of capital. Right? So if that were to happen, I'm not saying it has to happen that way, but it would make total sense to me if it did. Right? So there's your bearish count. We came up in a 1, in a 2, in a 3, in a 4, and minor degree, and an ending contracting diagonal in the 5th minor wave to complete intermediate 1. This is inside of of primary 3, which is inside of cycle 3, which is inside of super cycle 3. That's the secular bull market, which began in 2009 and continues to this day with higher highs and higher lows. The next bear market within this cyclical bear market, bull market cycle is about to begin. Okay, and we roll over and we go into another price correction of maybe 60%, maybe 50%, maybe 40%, who knows. And we come down in another sharp correction and most likely a zigzag. Okay, we find another low, and we'll be looking for all the signs of a low when it comes. Bullish divergence on longer and smaller time frames on the RSI and the MACD. We'll be looking for increases in volume. We'll be looking for the correct Elliott wave structure to form of 5 up and 3 back. Okay, we'll be looking for the correct sentiment to be coming off of that low. Extreme fear and pessimism. We'll be looking for the right liquidity at that moment. We'll be trying to marry it up with the macro at the same time. We'll be looking for all of those things. And we'll be looking at the time of the average bull market, the average bear market. But this is how the bull market ends. We come up, we've completed an ending diagonal, we come down now in a 2. Okay, so what about bullish counts? I've been extremely bearish, haven't I? I know I have. I don't even necessarily believe we topped. And yet, this is what we have to do. We have to consider these things. So what if it's this instead? Well, this is dead. Bull market, this count and the next one I'm going to look at both die when we go through that low of 74458 because they depend upon the sequence of higher highs and higher lows remaining intact. 1 and 2 at intermediate degree, 1 and 2 at minor degree, 1 and 2 at minute degree, 1 and 2 at minuet degree, and 1 and 2 at subminuet degree to come, and then the moon. Right? This is always my primary count as we develop through this bull market, but as time has gone on and it's failed to materialise, this idea, if it's going to play out, depends upon the bullish phase of this 4-year cycle extending into next year. This is going to require 2026 and most of it to get it done. Right, at least through to the summer, I would have said, because there's a lot of work to do. Right, the larger wave degree correction would probably be at primary wave 4. Here was a primary wave 1, sorry. Here is primary wave 2. The larger bear market would be probably 3 into 4 at primary degree, way off into the distance. Okay. Okay, and I don't think that could arrive until at least well into next year, if this count is correct. If it's not this count, how do we shorten it in time frame? We can shorten it with an extended fifth, where we've done 1, we've done 2, we've done 3, we've done 4, now we're going 1, 2, 1, 2 for an extended 3 within the extended fifth. Oh my god, what is he talking about now? So we go 1, 2, 3, 4, 5, right? And within this fifth wave, we get a wave 3 extension. Okay, it's gone a bit crazy high over there, but that's because I was in log. So 1, 2, 3, 4, and then we go 1, 2, 1, 2, here's the wave 3 extension, 3, 4, 3, 4, like that, and then 5. So we get a huge fifth wave, which itself has a wave 3 extension within it. Okay, this is going to take a lot less time than the idea of it being 1, 2, 1, 2, 1, 2 and extending. Right, and they're the two bullish counts. I don't see any reason for another one on the longer time frame. So it's either 1, 2, 1, 2 within a fifth, or it's 1, 2, 1, 2 within a 3 of 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 a 3. Right? And they're the two bullish counts. We have the luxury of knowing that both are dead, right, if we go back below 74458. Right? But where this idiot was going wrong was he seemed to be under the impression that we just keep buying a falling knife until that point and then we quit. Where he's probably going to be stupid enough to sell, get fucked in the arse, and then we do this. Right? So what we're looking for is the correct entry setup to occur any time between now and then in order to be bullish. Bearish, fine. Here's your retracement, you can sell from here. Here's a retracement, you can sell from here. Here's a retracement, you can sell from here. All the fucking way down. So don't sweat it. If you want to be a bear, be a bloody bear. No one's stopping you. Right? It's not an argument of I was right, you were wrong, or we were in a bear market. We're in a bear market, bring it on. I've already said that. Alright, sorry if I'm getting a bit irritated, but it has been very frustrating lately dealing with all this crap. But I still love it either way. I don't know what's wrong with me. I must be mentally ill. But anyway, there's the two bullish counts and the bearish count over the longer time frame. So now let's come in and zoom in on the shorter time frame, shall we? And make sense of this shorter term count. Right, so we're going to turn off the bull market dead thing here, and we're going to focus on this move up from April 25 into the highs of October. Okay, if we simply take ourselves off of log, because we do not want to be in log for when we're dealing with such a small area of price. Okay, when we're dealing with tens of thousands of percent or thousands of percent or even multiple hundreds of percent, we can work in log. When we're dealing with an isolated wave structure which is within a reasonable price range given the assets volatility we're dealing with, we can work in linear, and we probably should. So from that point of view, low to high, we have retraced 50% back into support. Okay, this is traditionally what I call the target zone between the 50 and the 61.8% Fibonacci golden ratio and the run over at 65, which is just where some algos like to push the price in case stops are waiting at the golden ratio. They can just get stretched on leverage a little too far for people to hold, wick it, and once it's been wicked, grab that money and run. I swear I turned those notifications off. Excuse me. Right, anyway. So here's your target zone, your target box. We're in that zone now. We could bounce any moment, okay, or we could come deeper and maybe come to these lower targets, okay, but nothing in the bullish case of the higher highs and higher lows is invalidating unless we come through 74441. Once we come through that, we can switch all of this off and stop trying to set up bullish trades. That doesn't mean we can't be trading short in the meantime and hedging out the risk. We're allowed to do that as well. There are no, it's not mutually exclusive. You're allowed to do what you think is best. 1 into 2 again. So how can we count it? Well, how about we look at it like, oops, daisy, sorry, like this. We're gonna have to come down to the 4 hour. So we came up in a leading diagonal. It wasn't part of a larger ending diagonal as the bearish count suggests, but it was a leading diagonal. 1, 2, 3, 4 and 5 into 1. A, B, C, B, and now 1, 2, 3, 4, 5 down. So there's multiple ways of counting it. The C wave is what we're trying to figure out. A comes to here, the B wave retraces in 3, past the 100% retracement of the A, but doesn't make it to the more typical B wave targets of the 123.6, 138.2 and 1618, which is the cutoff for a B wave, but it does go back beyond the 89, which is the minimum cutoff for a B wave. Right, so we go beyond the minimum, we do not go into the normal target range, but we do expand in the B wave. From here we come down in what can be seen as 5 into 1. That's the purple count. 1 into 2, then we could go 3, 4 and 5. Right, now we could go 3, 4, 5 and come deeper to a wave 2 target, so let's change that to a wave 2. Maybe 78.6, maybe 89, all the way down through all this support. Remember how bearish the attitude would be down here, how many people would be quitting. If we get into this circumstance and we're still above 74441, we need to start pricking up our ears and being super bearish, because we can now manage risk to a macro low. Right, so if we lose some money and we get it wrong, we better lose as little as we can, but lock in the possible maximum gains we can make. That's the whole point of risk management. So we could be coming down here in 5, or what if we're coming down in a diag? Okay, we're doing something like this. Right, we can shrink that 5 wave move down considerably by going 1, 2, 3, 4, 5. Maybe here at 61.8 we could go 3, 4 and 5. We come to the golden zone, we find our C, we find our 2, that's the 1 into 2 golden zone retracement, what we call the golden corner. Pitchfork goes on it, boom, here's the median line, off we go. First target's the median line to the all-time highs, 1618 extension beyond that, and then all the way to the top. Okay, and we start pushing for a very, very bullish count. At this point people would still probably be bearish coming off of that low. Okay, so what I'm saying is, pay attention while we're coming lower, right, as we're heading into the 50, the 61.8 and lower, above that high at 74441, we are looking for a bullish setup. Right, because even if everything long term is bearish, right, this is going to be our last chance to get a bullish trade in. It could be an A down and a B up. It could be a 1 down and a 2 back. It could be 20, 30, 40, 50% gains. It might be worth trading either way, right? If it does rebound such and doesn't make new highs, you could short. You've got options. That's what I'm saying. You've got options, right? You don't have to just do A or B. But either way, what if it's none of these? Then what if it has already put 5 in? So A came down, B came back, and then 5. Then C wave went 1, 2, 1, 2, 3, 4, 5, 3, 4, 5, and we end up with a really ugly impulse. Can't make it a diagonal because it overlaps too much. But if I go 1 and 2, 3 and 4 and 5, well, what do we know? 3 is not the shortest wave, that's legal. 4 does not transgress into wave 1, that's legal. Time frame between 4 and 2 is absolute dog shit and it's ugly as hell, can't do anything about that. But it's a legal structure. Doesn't look right, but it's a legal structure. 1, 2, 3, 4, 5 down. Came to the 50, which is also the 1618 extension for the flat. Right, I know I'm talking a lot. Let's talk you through it. Let's break it down into a super simple count. 1, 2. Right, 1 and 2. Where does it go? From the 1, it retraces to the 50 exponential. Retraces to the 50 retracement, 50% retracement into the target zone of 50 to 65%, with the golden ratio 61.8%. This is the target box, right? It has come down as A, B and C to here, with a rather ugly but legal impulse. Don't like it. I know I'm going to have my own patrons saying, oh Tom, I can't believe you're considering that, especially because you bitch so much about relationship and right luck and structure, but it's legal, right? If it's not that, it could be 1 and 2 to here, 3, 4 and 5 to here to get the C and the 2 at a deeper target. From there, you are guaranteed, well, in Elliott wave terms, an 80% odds of a new all-time high. Right, if you lead with a 5 and a 3 off of that retracement of 5 up and 3 back. Okay. So, what's the other target that's interesting here? Take the length of the A, project it from the B. And what do we get? 618. 1618 perfectly. Right, the wave C extension comes to the exact target for an expanded flat of a 1618. It comes to the 50% retracement. This, and it comes back into major support. This is a very interesting point. This is a very interesting area right now. Yes, it could come deeper, but this itself is interesting. You can manage risk from here. You get a move up and a move back. You can manage that risk down to a teeny tiny amount. Right? That's like 2.3%. If you just said, oh, fuck it, that'll do for me. Right, I'll take that trade in the short term. If I'm wrong and it comes lower, I get closed out. I wait for another setup to come along. That's 3.4%. Okay, you see what that idiot who didn't appreciate that the market doesn't invalidate until 74,000. See what he was missing? He was missing all of the opportunities before that point. Okay, so there you go. That is the shorter term count. We could be into a 1 into a 2. We don't need to consider the extended fifth because it's the exact same count again. 1 into 2. Right, except it's a minute degree rather than minuet degree, and we're in the fifth and final wave rather than a 3 over 3 over 3 over 3 over 3. Okay, same idea. ABC. What if you don't like ABC? What if you can't deal with that being a flat? Oh, I don't like it. Well, you could always say WXY. W to here, X to here, Y to here. I don't like it, but I could live with it. Now, you want to learn a little bit about Elliott wave for a moment. Why don't I like it? This has to be classified as a zigzag, and this would have to be classified as a zigzag. This makes this a double zigzag. What is the purpose of a double zigzag? The purpose of a double zigzag is to create a trend of lower lows and lower highs, and to push the Y wave beyond the W wave. Now, does it achieve that? Yes, it pushes the Y wave beyond the W wave. It achieves the function of pushing 2 zigzags lower. However, does it create a downward trend of lower lows and lower highs? No. We've got a new price extreme here. New prices extreme occur in flat patterns vast majority of the time. The vast majority of the times. Almost to the point where it's not worth thinking about the alternative. Okay? So it's not functioning like it's not functioning like a DZZ, like a zigzag. It's pushing price lower, but it's creating a new price extreme while it's doing it. It's not illegal. It just shows a bit of disrespect for Elliott wave in terms of what we'd expect to see. Can you wrangle it to be something else? Maybe it's a push, but I don't think you could. Could you get this structure in here to be a flat, and then you can say, well, how do I get the initial wave to be a flat? I don't think you can. I think that's the initial wave. This is a zigzag, so the X wave. We do not care if this is a flat or a zigzag, right? That's the connective wave, that's the X wave. That could be a fucking triangle, it could be anything, it doesn't matter. What matters is connecting this to this, right? To the W to the Y, okay? And in that regard, a B wave fits better for a flat. But I'm not going to discount it. If you want to put it on, you can say, all right then, larger flat WXY. Right, but I feel that even with the poor relationship of this 5-wave structure down for the C or the larger, I'd rather accept that than say WXY in terms of probabilities. And there you go, guys. That's an awful lot of talk today, isn't it? My God, 50 minutes. You must be sick to death of me. But I wanted to be thorough. So let's do a quick recap. Bear market. We're done. Price topped at 126.243 spot 80. We're in a sharp zigzag down now, at least to the 50 to 61.8%, anywhere between 70 and 50,000. We could come deeper. We're in winter. The bear market is here. The 4-year cycle takes precedence. The sellers have arrived. Game over. Welcome it. Embrace it. Learn from the previous mistakes in the previous cycle. Leave behind the 3.5 million bullshit projects and come here, where there's a secular bull market in place since 2009. Okay? Or we have wave 3 extension. We're in a wave 2 at minuet degree, looking to complete before we continue to new all-time highs and way beyond. Extended fifth, we won't go as high and we won't take as long to do it, but it's the same jig. It's the same gig. Both of these bullish counts die at 74444120, but you've got a lot of options about how you want to trade before we get to that point, as we've discussed. Alright then guys, thank you very much for joining me on this technical analysis of Bitcoin. I hope you've enjoyed it. If you're new to the channel and you like what you've seen, please subscribe, smash the like, hit the little bell notification icon to remain informed of future video releases. And if you want to learn Elliott Wave for yourself, and you want to learn some trading techniques for yourself, and you want to get access to a big public Discord, you want to get access to weekly update videos for Bitcoin, for gold, for the SPY, and a cover other markets, and you want to get the opportunity to request coverage of your own assets that you want me to look at, which I do eventually get around to, all of that's available by joining the Patreon at tier 2 and above. And there's a link in the description box below if you're interested. Take care of yourselves, guys. Always look on the bright side. I'll be back with you as soon as I can. Take care. Bye bye.